This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter, and joining me for this episode is Ryan Kelley, the Chief Investment Officer of Hennessy Funds. We're going to provide a mid-year update and discuss the current investing environment. Ryan, great to have you on Viewpoints by Hennessy.
Great to be here. Good to see you, Jay.
All right, let's dig right in. Looking back at the first 6 months of the year, what stood out to you the most?
I think overall, we've seen an incredibly resilient market. This is despite some periods of volatility, but overall, the S&P is up 15%, about 15% for the year. But in the sector by sector, we've seen a lot of differences. The tech sector is up almost 40% year to date, and some sectors are negative. So that's a pretty big disparity. And this resilience, I think, is important to focus on given what's actually happened during the last 6 months. I mean, yes, all of the data on inflation and Fed rate hikes, those are very important. But let's take a look at financials. We had the second and third largest bank failures in history. And yet, while banking and the banking sector has certainly suffered for the first 6 months, overall, to see a market that's up 15%, means that at least has been mostly contained, it seems, mostly to some smaller and mid-sized banks. And overall, while credit conditions may be tightening, for the market to continue to go up as much as it has, that just shows a lot of resilience.
So we're recording this in July of 2023. Today, CPI numbers came out lower than expected. What's your take on inflation today, and what does it mean going forward?
Sure. Well, today's CPI number for June up only 3% year over year. I like to focus on the year over year changes. That's obviously we see inflation continuing to trend downward. That's very important for the market. That's very important for consumers. I think the one thing to remember, though, is that we talk about month-over-month inflation. We talk about year-over-year inflation. But think about what consumers are experiencing now versus 3 years ago. And that's where I think some of the actual ramifications we've not really completely seen yet. Right now, we're paying 3% more than we were last year for goods and services. Well, last year at this time, we were paying 9% more than we were the prior year. And then the prior year, we were paying 5% more than in 2020. So overall, we're talking, 17, 18% more for goods and services than we were back in 2020. So, I think it's great to see the downward trend. I think that we've come through this, especially consumers, pretty well so far. But we really need to keep an eye on how this plays out going forward as well.
So, Ryan, how do you think the Fed will operate moving forward given this?
Well, I think, we've come through an incredible time when it comes to what they've already done. They've done 10 consecutive interest rate hikes over 14 months. That was up until the last meeting, that is, going from 25 basis points to 525 basis points, the highest it's been in 16 years. We think actually that they are very close to done. There might be one or two more this year. They might spread them out over more of a prolonged time period throughout the second half. But overall, we will eventually see a dovish Fed. And that's going to be really good for the market. I think that until we start to hear at least the rhetoric and all that the Fed speak, so much Fed speak that they have, once it becomes more dovish, I think that's going to be very good for overall investing.
Could you put a general time frame around how you think this will be beneficial for the equity markets?
Well, I think that for the next 6 months, there's still going to be some volatility. We're going to see more numbers come out. We're going to see some maybe an uptick here or there of inflation and then a downtick. It's going to continue to make a lot of people uneasy with where the Fed is going to go. And there's still, much of the Fed is pretty hawkish when you listen to their statements. But really what it comes down to is eventually they'll become more comfortable with where we are as an economy and where consumers are and where inflation is. And then eventually, by the end of the year, I'd say they start to talk a little bit more neutrally and a little bit more dovishly when it comes to Fed speak.
Let's talk about artificial intelligence for a minute. So, as the Chief Investment Officer at Hennessy Funds and a portfolio manager, how do you see AI impacting your business?
It's a great question. It's certainly something that I've been thinking a whole lot about. AI is an incredibly powerful tool. There's no doubt about it. And it's going to certainly transform a lot of our economy. It's going to transform a lot of our jobs. We're going to have some jobs which are gone. We're going to have some new jobs which are created, honestly. And we're going to have probably the majority of the change is going to be more workers working with AI, alongside AI. So when we look at the asset management business, when we look at the investing, AI will be certainly important. It's growing. It's there. It's very powerful. But I think what we have to do as an industry is make sure that we're in front of the potential risks that come with AI. The good news is we are a highly regulated industry. The SEC, I hope, will stay in front of this, and that'll be, wait to be seen. But overall, I think that one of the biggest things that we need to grapple with is this idea of a prudent investor. When it comes down to the way that we invest, when it comes down to the way that you and many other people invest your own money, and you're investing other people's money, are you doing it in a prudent way? And that's what it comes down to: is can a computer actually be deemed to be prudent? So we'll have to wait and see.
So when we look at the economy moving forward, we're recording this in the middle of 2023. How do you see things playing out the rest of the year?
Well, overall, I think the economy is in pretty good shape. It's obviously slowing down this year. It may even slow down next year. But when we talk about the real economy and the effect of inflation on GDP growth, that certainly is detrimental when we see higher inflation. But on the flip side, what we have to also remember is that for individuals who rely on, or even companies that rely on income generated from investments, whether it be fixed income, treasuries, savings, bank accounts, et cetera, all of that is much higher now. And that's very beneficial for any savings that you might have. I mean, what I had in the bank 2 years ago was basically earning nothing, and now I can put it in a money market at 5%. So that's very beneficial. So I think overall the economy is good, consumer is strong, still flush with cash, spending is still staying up, and I think that probably will continue going forward as well.
As Chief Investment Officer at Hennessy Funds, given the broad array of mutual funds that you have at your firm, it really gives you a wide lens into the different sectors and subsectors of the markets. In your experience, what do financial advisors and investors overlook when it comes to diversification?
Well, when it comes to diversification, I think that, certainly, of course, diversification reduces risk on an overall portfolio or an overall clients' investments. But I think that also when you're only focused on diversification, you end up lacking differentiation. And we believe here at Hennessy that when it comes to our own investing, when it comes to our own portfolios, that we'd rather have high conviction portfolios and reduce risk in a different way. We reduce risk by, in many cases, adhering to a very strict valuation framework when it comes to investing. So, when you look at overall asset allocation for an investor's portfolio, diversification is certainly very important. But when it comes to the actual funds that we run, we'd rather have more high conviction portfolios. We have 17 different funds right now. All of them are pretty low in the number of holdings. Most recently, as of June 30th, there were ranging from 11 to 64 holdings in our funds, and with an average of about 30. So that's pretty high conviction portfolios when you look at the broader market.
Would you say that's the number one way Hennessy differentiates itself in the marketplace?
I think so. That's certainly one of them. It is another way to look at this is we look at active share. So you can have a lot of names in your portfolio. You can have a few names in your portfolio. But another way of looking at each portfolio and how you compare to your benchmark is a number called active share. Active share is calculated such that an active share of 100% means that you are completely different from your benchmark. And an active share of 0% means that basically you own the exact same companies as your benchmark in the exact same weightings. Right now, across all of our funds, except for our hybrid, and we have one index funds, if you take those out, the rest of the funds have an average active share of about 87% as of June 30. So that's a pretty high number. It means that we're not closet indexers. We're not trying to adhere to a particular way of investing, but rather we're having higher conviction portfolios, always looking at downside risk and making sure that we're differentiated.
Yeah, Ryan, that's a clear differentiator. I appreciate you coming on Viewpoints by Hennessy. Viewers, learn more about Hennessy Funds by visiting hennessyfunds.com. That is hennessyfunds.com.
Thank you.